Okay, good afternoon, students. Today we will be covering the economic concepts part 1. There are two parts, part 1 and part 2. In this particular video, we will start with part 1. I, Dr. Rohan Prabhakar Devale, welcome you all. Few fundamental economic concepts, we are going to study in this particular chapter. Some fundamental economic concepts relevant to business have been discussed here. So we will be discussing in this particular PPT demand, the concept of supply, production, distribution, consumption, consumption function, and cost. In the next PPT, we will be discussing the price, competition, monopoly, profit, margin and average, optimization, elasticity, and the concept of firm and industry. So, very first concept, we will start with demand. So, ordinarily, by demand is mean the desire or want for something. In economics, however, demand mean much more than that. The economics meaning of demand refers to effective demand, that is, amount of buyers are willing to purchase at a given price or over a given period of time. So, from managerial economics point of view, thus the concept of demand may be looked upon three concepts. Maybe demand is the desire or want backed by the money power. We'll discuss all these later on. Second is demand is always related to price and time. And third is demand may be viewed as ex ante or ex post. So we'll discuss these three concepts. First concept is demand is desire or want backed up by money. Here, as far as managerial economics is concerned, demand means effective desire or want for a commodity, which is backed up by the ability that is money or purchasing power, and willingness to pay for it. So, in short, we can say demand is equal to desire to purchase plus ability to pay, that is purchasing power or maybe backed up by money, plus willingness to spend. Obviously, to a businessman, a buyer's wish for a product without possessing money or to buy it or willingness to pay it for a particular given price for it will not be constitute a demand for it. For instance, maybe a Popper's wish for a Maruti car will not constitute its potential market demand as he has no ability to pay for it. Likewise, maybe a particular person's desire for the same, how rich he may be or she may be, will not become an effective demand when he or she is unlikely to spend the money for the fulfillment of that desire. So, demand is the desire and want backed up by money. The formula is also given to you. Next is demand is always related to price and time. Demand is an absolute term. It is a relative concept. Demand for a commodity should always have a preference and reference to price and time. For instance, an economist would say that the demand for grapes by a household at price rupees 40 per kg is 10 kg for that particular week. So demand is always related to price and money. Next is definition of demand. The demand for a particular product refers to the amount of it which will be bought per unit of a time at a particular price. So economists always mention that amount of demand for a commodity with reference to a particular price with a specific time period such as per day, per week, per month or per year. They are not concerned with a single isolated purchase, but with a continuous flow of purchase. In economic studies, therefore, demand is expressed as so much per period of time. Let's say 1 million oranges per day, or say 7 million oranges per day, or maybe 365 million per year. Last or third concept is demand may be viewed as ex ante or ex post. Demand for a commodity may be viewed as ex ante, that is, intended demand, or ex post, that is, what is already purchased. The former denotes potential demand, while the latter refers to the actual amount of purchased. So, this is about the first concept, that is demand. When there is demand, there must be supply. So, our second economic concept is, what do you understand by supply? So, in economics, supply during a given period of time means the quantity of goods which are offered for sale at particular prices. Thus, the supply of commodities may be defined as the amount of the commodity which the seller or producers are able and willing to offer for sale at a particular price during a certain period of time. Supply is relative term. It is always referred to in relation to price and time, like we have studied in demand. A statement of supply without reference to price and time conveys no economic sense. For instance, a statement such as supply of milk is 500 liters is meaningless in economic analysis. One must say supply at such and such a price during a specific period of time. Hence, the above statement become meaningful if you are going to say like at the price of rupees 20 per liter, a dairy's farm daily supply of milk is 500 liters. So here both price as well as time are referred to the quantity of milk to be supplied. Secondly, supply is what the seller is able and willing to offer for sale. The ability of a seller to supply a commodity, however, depends on the stock available with him. Thus, the stock is the dominant supply. Similarly, another dominating or determining factor is will of the seller. A seller's willingness to supply a commodity, however, depends on difference between the reservation price and the prevailing market price, or the price which is offered by the buyer for the commodity. If the ruling market price is greater than the seller's reservation price, the seller is willing to sell more, but at a price below the reservation price, the seller refuses to sell. In short, supply always means supply at given price. At different prices, the supply may be different. Normally, the higher the price, greater will be the supply, and vice versa. Third concept in managerial economic terms is production. Production is an outcome of economic activity. Its purpose is satisfaction of wants, collective or individual. Production is meant for changing the form or arrangement of matter by man in order to create further utility and make it more useful for satisfying human wants. Consumption is not possible without production. Production means the process of transforming the factors of production, such as land, labor, and capital, into various goods and services. It is the process by which the inputs of factors of production results into output economic goods. Production eventually means creation of utilities such as form utility, place utility, and time utility. It implies creation of additional utilities by changing form, place, and time. So we can have 3 points to discuss. First is production by changing form. That is manufacturing activity leads to creation of form utility. For example, changing of cotton into cloth or changing of wood into furniture is the production by which creating form utility happen. Second is production by changing place. Activities related to the change of place of commodities, that is bringing apples from Simla to Mumbai, is also regarded as production as there is creation of place utility. Third is production by changing time. Supplying the goods at a time when they are needed most is production by creating the time utility. Traders, for instance, keep stocks of goods for sale at a proper time to satisfy the buyer's need when the demand rises considerably. We can say in the winter season, the shopkeepers are keeping the woolen clothes and sweaters and all. Preserving fruits in cold storage and supplying them during the off season is production by creating time utility. The utility of stored grains and grass increase during the pre-monsoon period and in the event of a famine or a scarcity. This is also you can say as a production. As a matter of fact, creation of place utility and time utility may be described as distributive services or exchange activities. Thus, production includes transportation, trading and commerce, together with industry and agriculture. Therefore, all productive economic activities are the process of production of material goods. Non-material goods resulting from direct services of doctors, lawyers, teachers, maybe dancers, musicians, actors, etc., are also regarded as the production. According to J.R. Hicks, any activity towards the satisfaction of other people's want through the exchange is production. So value, that is in use of the commodity produced, is also increased because its utility has increased. Hence, production is also the creation of values. Now we will see what are various features of production. The concept of production would be still clearer if we notice the various features of economic production or productive activity. There are five terms. First is wider term. Production is a wider term which relates to both goods and services produced in different sectors of the economy: agriculture, mining, manufacturing, trading, transport, communication, banking, and other professional services like those of doctors, lawyers, teachers, etc. Second is Second feature is creation of value. Production implies creation of economic goods having exchange values. Production processes thus result in creation of value measurable in terms of money, that is price. Third is transformation of resources. Production refers to transformation of productive resources, that is inputs, into remarkable goods and services, that is outputs. The term inputs or productive resources means factors of production. Thus, production is a result of combined efforts of various factors of production, that is land, labor, capital, enterprise, that is famous 5 M's, that is man, material, manpower, machineries, money, and various processes. Fourth feature of production is it is complete process. Production is the complete process in the creation of economic goods to satisfy customers' wants. Thus, production implies to process necessary, say, from manufacturing to marketing, to bring goods into the hands of the customers. Last feature is flow over a period of time. Production is a flow concept. Thus, productive activity is measured as rate of output per unit of time period. That is, you can say 1000 TV sets sold or produced per month by an economic or electronic firm. Firm as a producing unit. The firm is a producing unit. It is a business unit which undertakes production activity. The firm buys and coordinates the services of productive factors such as land, labor, and capital, along with its organization for producing a commodity and sells it in the market to the households. The firm is controlled by entrepreneurs who undertakes major decisions such as what to produce, where to produce, how and how much to produce, whom to sell, and at what price. The firm hires factors of production and pays them remuneration to compensate for their productive services. In short, the firm organizes the business and bears risk. Thus, a firm that is entrepreneur or a businessman, as the owner or controller of the firm, earns profit as the reward. Firm owns or organizes a plant. It may be a factor or plant as a production plant containing shed, machineries, equipment, etc. A plant is a place arrangement for a production process where firm is a decision making unit. The fourth concept is distribution. After production, we are having the concept of distribution. In a modern economy, production of goods and services is a joint operation. All groups of factors of production, namely land, labor, capital, and enterprise, are combined together in product productive activity. So, productive activity is thus the result of the joint efforts of these four factors of production, which work collectively to produce wealth. These factors need to be paid or rewarded for their services for producing wealth, and hence the problem of distribution follows. Distribution thus refers to the sharing of wealth that is produced among the different factors of production. The wealth is produced by people in the following forms. First is rent as share of land, second wages as remuneration for labor, third is interest as return on capital, and profit as reward of enterprise. Distribution thus implies the division of national income amongst the different classes: landlords, laborers, capitalists, and entrepreneurs. It is enough and through the distribution of production that different individuals in the community receive their income. Thus, distribution is an economic method by which the real wealth, collectively produced by the agents of production, is divided or distributed among them. Now we will see the difference between functional distribution versus personal distribution. In economics, the term distribution has the least two connotations. First is functional distribution and second is personal distribution. Functional distribution refers to the distinct share of national income received by the people as agent of production per unit of time as a reward for the unique functions rendered by them through their productive services. These shares are commonly distributed and described as wages, rent, interest, and profits. Briefly, thus, functional distribution relates to the share of the factors of production in the form of rent, wages, interest, and profit in the aggregate function. We can say it is a macro concept, whereas personal distribution, on the other hand, is a micro concept. It refers to a given amount of wealth and income received by individual in the society through their economic efforts. That is, individuals' personal earnings of income through various sources. The concept of equality and inequality of income distribution and social justice is basically concerned with the personal distribution of income. Taxation measures are designed to influence the personal distribution of income and wealth in a community. The theory of distribution deals with the functional distribution and not with the personal distribution of income. It seeks to explain the principles governing the determination of factors reward, that is the rent, wages, interest and profits, that is how prices of the factors of production are set. Needless to say, rent is the price of land, wages is the price of labor, interest is the price of capital, and profit of the enterprise. The theory of distribution thus states how the product is functionally distributed among the cooperating factors in the process of production. The theory of distribution does not explain what is the income of each and every individual in the community and why it is so much. It just explains how labor as a whole, or as a class, as a factor of production, would receive its share of national income and as also other factors of production. Fifth concept is consumption. Consumption is the action of consumer for using the satisfaction of given wants. Consumption, however, does not imply the using up or destruction of goods. In the consumption process, there is destruction of utility. Its end result is the satisfaction of want. In the consumption of perishable goods, however, with the destruction of utility, the good is also used up or literally consumed. It vanishes or disappears in the process of consumption. Example, when we drink milk or tea or eat banana or some biscuits, they are also destroyed together with the destruction of utility for satisfying our thirst or maybe hunger. Whereas in the case of durable goods, though their utility is destroyed, goods remain in existence. The depreciation of such goods is slow. So the same goods go on satisfying our wants again and again. Their utility remains till they become old and deteriorate or break down. You can say example of a car. Thus, a car is used does not disappear after usage or after one usage, and if well maintained, may not be perishable. But in the real consumption process, we definitely exhaust its utility through gradually by using its services in a steady flow over its life period or period of lifetime. Further, wealth and not capital is consumed by the consumers for satisfying wants. Example, when we travel by railway, we directly consume railway services and not the rail carriage or engine. Engine or train compartment is just capital for facilitating the railway services. At the most, this is regarded as the indirect consumption. Briefly, thus, consumption is using up of the utility, maybe directly or indirectly, when we come to satisfy our wants. Now, what is importance of consumption? Consumption is the beginning and end of the economic activity. Wants are satisfied through the consumption process, the consumption of goods, and wants are the starting point of economic activity. Thus, the desire of consumption comes before the production. Producers produce goods because they want there is a want and there is a consumption, and every economic effort results into production of goods and services. This production is ultimately consumed for the satisfaction of wants. Second importance is production and consumptions are associated with each other. Without production, consumption is not possible. Without consumption, production is useless. Third is, in a market-oriented company, consumption behavior of the consumer and their demand pattern determine the mode of production. So thus consumption is extremely important in economic concept. Next we'll discuss household as a consuming unit. In a market economy, households and firms are the major economic entity. Microeconomic theory deals with the behavior in particular. The household refers to a basic consuming unit. A household may be defined as an individual or a group of individuals in a family under one roof who undertake decisions regarding consumptions for satisfaction of their numerous wants. In macroeconomics, thus the household is a consumer. In macroeconomics, household is a consumer. It seeks to describe consumer behavior in demand theory. The behavior of household is important because it constitutes demand for a commodity. The market demand is composed by the aggregate of individual demand. A consumer is sovereign in the market economy. He consumes his want and buy goods according to satisfy them. Consumers' preference is thus very important in determining the pattern of demand as well as the form of production in a market. Since a consumer has many wants against his limited income, he has to make a rational choice. What is scale of preference? Scale of preference means the arrangement of wants and the relative preference of goods in accordance with the degree of intensity or urgency of different wants. We have to arrange our wants according to the scale of preference because our means to satisfy our wants are limited. It is because our wants are of varying importance and that they cannot be arranged on our scale of preferences so that choice is possible. A man will give the highest order of priority of preference to some wants and put other want in a descending order of preference. This ordering of want is called as scale of preference. Every consumer has his unique scale of preference. It is obvious that the scale of preference will differ from individual to individual, from time to time, and from place to place. Today we might refer to coffee, and some other day we might prefer coffee to tea. Human beings may be conscious or unconscious, rational or irrational, consistent or inconsistent in preparing a scale of preference. Sixth concept is consumption function. Consumption expenditure is the major constituent of aggregate demand in an economy. The level of community's expenditure on consumption is determined by a multitude of the factors such as household income, taste and preferences, current and expected prices, expected future income, holding of liquid assets, interest rates, debts, real wealth, advertising and sales propaganda, taxation, inflation, and availability of goods. Keynes, however, assume that in the short run, real consumer spending is primarily determined by the current real personal disposable income, that is gross personal income minus the personal tax liabilities. According to Professor Hansen, he remarks that income is singled out as main determination of consumption, just as in the case of the familiar demand wave, price is singled out as the primary determinant of the quantity taken. In specific terms, Professor Keynes held the current consumption depends upon current disposable income. A rise in income leads to a rise in consumption and vice versa. The empirical consumption-income relationship is represented by the consumption function. The consumption function or the consumption function or prosperity to consume is nothing but an expression of an empirical income consumption relationship. You can say in technical terms, Keynes postulate that is function of the income. Algebraically, you can write down the relationship between the consumption as the dependent variable and total income as independent variable. You can express it as C is a function of Y where functional value is greater than 0. So fundamental idea of Keynes economics is that an increased level of employment can only be achieved and maintained by an increased level of expenditure on either consumption or investment or both. So fundamental idea here in economics is that increased level of employment can only be achieved and maintained by an increased level of expenditure on either consumption or investment or both. So in short, effective demand, which determines the level of employment in an economy, is determined by the size of aggregate demand expenditure or the aggregate demand function, which is composed of consumption and investment functions. The consumption functions appears to be significant factor determining the level of effective demand in an economy. Consumption function is the propensity to consume, denotes the consumption demand in an aggregate demand of the community, which depends on the size of the income and the share that is spent on the consumption goods. The propensity to consume is a schedule showing the various amounts of consumption corresponding to different level of income. Thus, by consumption function, we mean a schedule of a functional relationship indicates how consumption reacts to income variation. So, on the basis of the fundamental psychological law, observed that an income increases, consumption also increases, but less proportionately. Secondly, he also states that propensity to consume is relatively stable in short run, and therefore the amount of community consumption varies in a regular manner with aggregate income. Since consumption increases less than income, there is always a widening gap between the income and consumption in income as income expands. So Professor Keynes thus argues that in order to sustain the level of income and employment in an economy, investment demand should be increased because consumption demand is relatively stable component of the aggregate effective demand. Seventh feature is cost. Production is the outcome of transformation process under the employing various resource input together. These resources comprising various land, labor, capital, and entrepreneurs are called as factor production. We have seen in the production tab. To secure a regular supply of these factor units, a firm compensate the factor owners in the form of payment of rent, wages and profit. From the factor owner's point of view, rent, wages and profit are income, but to the firms they are cost. The volume of that a firm produces depends upon the cost of factors and the price of the firm is likely to get the output. These considerations also determine the profitability of a produced commodity. The cost of production goods depends on the number of factors unit necessarily to produce level of output and the prevailing prices of the factor units. The number of factor units required in turns depends on the technique of production, the efficiency of the factor units. As such, The cost of production is jointly determined by the technique of production adopted, the organizational efficiency of entrepreneurs, and the productive efficiency of factors and their prices along with the rate of output and size of plant. There are different viewpoints on the cost concepts. We'll review some of them, like we'll review outlay cost and opportunity cost. Outlay cost refers to actual financial expenditure of the firm. It is recorded in the firm's books of account. For instance, payment of wages, interest, cost of raw material, cost of machineries, etc., are the actual or outlay costs. Opportunity cost, on the other hand, is a notional idea. It is not the actual expenditure incurred by the firm. It is measured in terms of opportunity lost. It represents sacrificed alternatives. Opportunity cost may be measured in terms of profit from the next best alternative ventures that are foregone by the firm by using the available resources for a particular business. Usually, the opportunity cost of investing own capital or investing own capital fund in the business is measured in terms of the current interest rate, as businessmen could have lent this money instead of investing in business earn interest thereon. Thus, interest is the sacrifice of the investing own business capital. It is its opportunity cost. It is just a notional idea which does not appear in the book of account. Thus, opportunity cost is measured in terms of foregone benefits from the next best alternate use of the given resource. So, the opportunity cost may be defined as the opportunity cost of a given economic resource is the foregone benefit from the next best alternative use of that resource. In other words, opportunity cost of producing certain commodity is the value of the other commodity that the resource used in its production could have produced instead. It should be noted that opportunity cost of anything is just next best alternative, the most valuable other commodity foregone in the use of